All right, good morning and welcome back to the Money Advantage podcast. This is Rachel Marshall and Bruce Wehner, and today we're here to talk to you about a very important concept. And depending on your perspective of where we are in world events and history and the strength of the dollar, this episode may hit you in one of two ways, but we're talking today about what happens specifically to infinite banking, and you're thinking about infinite banking in the event of a economic collapse or a dollar reset. We have people who are asking the question, and so we want to address this head on with really this concept of what happens if the dollar goes away or is no longer the reserve currency of the world. And today we're talking about that question and not just answering that question, but really opening up the lens and the perspective, the aperture, if you will, that there's multiple perspectives of whether this will happen and or not, and really how to embrace and approach the best, healthiest perspective and mindset, considering the set of circumstances we have available to us and the data that we have. So, Bruce, I'm really excited to talk with you about this today because I think it's something at the forefront of some people's minds, especially when they're thinking about how do I make sure I'm prepared for the future, whether that is uncertain, whether there's instability in the US economy, in the world economy, whether we can trust the dollar, whether there's so much with our faith in our financial currency system. And so today we're going to be talking about that exact question. Bruce, thank you for joining me today.
Yes, this is I understand this is on people's mind, but what I want everybody to think about is the source of the information, including, like, I always challenge people to even, you know, uh, determine whether you're listening to us and you think it's a good source of information. So what I have, what I, obviously people are leaning on this because we have tremendous amount of debt at this time period, um, north of $36 trillion dollars. And in the history of the world, that's always been a issue for economies. And at that time, if it gets too large of a debt to their GDP ratio, something has to give. The difference, I think, here is that we're a much greater global economy from when it was happening beforehand. I'm not saying we're out of the woods, but when you have a greater global economy, I think there's much more reliance on each country on each other, where before, if that happened to a country and they were much more isolated, they just couldn't get out of it as easily. And the second thing is that I understand that a lot of people that like the infinite banking concept tend to be conservative people. They like the private nature of it. They like the conservative nature of how you do business. They like the conservative nature of the um, the insurance company, how they handle the money, the guarantees, so on and so forth. And so when they say to themselves, "But the guarantees are backed by the U.S. dollar," then I don't understand how that can affect it. Well, the, as we go through this information today, you have to understand, I believe, that the dollar may go away, but it's going to be replaced by something. And probably because of the size of our economy, it's not going to be replaced by a foreign currency. It may be replaced by something else, the way we have to do it in the United States. And it could be replaced, and we'll keep this for another show, but it could be replaced by some kind of cryptocurrency, potentially, if not in the near future, in the future. But I would like to say potentially. So then you have to say to yourself, well, if there's going to be a currency, how does it affect the current policy? It is my opinion, because of the guarantees and the way that the insurance companies handle whole life insurance, you have to really worry about not the whole life, but other forms of permanent insurance, such as index universal life, and variable universal life, because those have actually put the guarantees on of success on the individual, where the whole life has put the guarantee of success on the life insurance companies. So let me give you just one example, and then we'll ask some other questions. When an insurance company has a whole life and they have the guarantee put on them, the insurance company, they actually are going to test this and back test this and actually put in, this isn't a technical term, but they're going to put in fudge factors. They're going to put in for the worst case scenario. So that is why dividends are not guaranteed, because they are actually figuring that bad things can happen. And if they don't happen, then the dividends will be higher. If they do happen, then the dividends will be lower. So, yes, I would agree that maybe the returns that the insurance company would get maybe aren't as great, but they've already figured in some of that fudge factor so that they can still handle their guarantees and more than likely still pay their dividends, because we had high GDP ratios throughout all World War II also. And they didn't miss a beat during World War II. So when you think about it in that logical way, then I think the insurance company, especially whole life insurance, is solid. Now, the last thing, Rachel, and I'll turn it over to the other questions we want to answer about this, is that when you are comparing this because you're worried about the guarantees, whether they're going to pay dividends, so on and so forth, what you're doing is saying, where should I put my money? Should I put it here, or should I put it in some other asset? Well, that's not what the infinite banking concept is about, because whether we have a good economy, whether we have a bad economy, the banking function is still going to go on in your life. And especially in a bad economy, who do you want to control the banking function? Do you want to give that control up to somebody else, or do you want to put your money in an institution that you control? Because I would think in a bad economy, having, or where there's turmoil from replacing the currency or devaluing the currency, having the money in the bank wouldn't be a great idea either, especially with some of the Dodd-Frank rules, so on and so forth, the bail-in rules. So those are my general overall thoughts, and now we can dig into it a little deeper.
I think what's really interesting about this whole concept is that, and Bruce, you and I were talking a little bit yesterday about this question, because this question seems like it has come up in multiple different ways at different times through whether YouTube comments or email comments and questions. And obviously, there is concern about the long-term strength of the US dollar. And I think the nature of the question comes from a position of looking at the entire global economy and really recognizing that currencies have been devalued in the past through hyperinflation, and the US dollar is not immune to those kind of things. And so when the question is being asked, I want to just talk about some of the thinking and the thought process behind that and how we're understanding your concerns. And then, Bruce, as we were talking yesterday, it's really important to separate that concern and step back and really look at the big picture, still in a position of recognizing that we don't need to do everything just for that one potential concern. So we say this in so many different ways and so many different contexts, but whole life insurance really puts you in a position to have most certainty. And this goes way back to an article that Les McGuire wrote, a gentleman who was really strongly in the infinite banking world, and he ended up passing away. But he wrote this article called The Economic Value of Certainty. And when you have certainty, you have so much more solid ground beneath your feet. You have a foundation to make strong decisions from, and you can be more confident in your decisions when you have certainty. And so life insurance really helps you be in a position of having the most certainty in the widest range of circumstances. What that means is that whatever economic environment, whatever cultural environment, whatever happens with the dollar, when you're in a position of strength by having control of your capital, you are most poised to take advantage of whatever comes your way, meaning that you have the best opportunity because you're best positioned for the widest range of circumstances. So I just wanted to come at it from that angle first, but just recognizing your concern. Bruce, I love that you just talked about most of the people who are most interested in infinite banking want that personal control and do have a lot of those conservative values. And I think when we look at the big picture, we look at the dollar being the world's reserve currency. We look at the dollar being what is used for economic trade and investment and financial transactions. Um, Bruce, I know that you could probably even speak to this more than I can, but back in 1944, there was the Bretton Woods Agreement where the world decided, all the countries decided to use the dollar as the world reserve currency and also pegged the dollar to gold. And so there was this hard asset backing the dollar at that time. And then you look at over time, we've had a really large economy, but we're in a position where there is that inflation. We do have the Federal Reserve that is printing dollars, and they're using the printing of money to control interest rates. And they're in a position where the more dollars that are printed, the more it devalues the current dollars that are in circulation. And because of that, we see not only the inflationary side of the US dollar by the central banks, which is the Federal Reserve, but also by our lending system, and you look at what is happening with that, you recognize that also Nixon took us off the gold standard in 1971. That was really the end of the Bretton Woods system. And so when you look at what's happening with the dollar, you could say, well, we're no longer pegged to gold. We do have this debt situation, and we're in a position where it's not as strong. And so the question then becomes, well, what if we lose that reserve status? What if the dollar goes under in terms of the kinds of things? And Bruce, you said back when there were more isolated economies, things were happening in, I mean, people have probably all heard of Argentina, Venezuela, Zimbabwe, where the dollar was worth almost nothing, and you have a whole wheelbarrow of money to buy a loaf of bread because the dollar was, or their currency was so devalued. And so you can look at, could that happen to the US dollar? And if so, if I'm holding my money in dollars, which whole life insurance is something you pay your premium with dollars, your death benefit is in dollars, and your cash value is in dollars, what happens to that cash value and my ability to count on that if the dollar crashes? And so that's really the nature of what's behind the question. And so that is assuming that we're going down a trajectory of having devalued dollars, the person who's asking that question. So we want to recognize where that context of that question is, but then recognize that we also can pull back from that and recognize that there are more factors at play than just the devaluation of the dollar. But Bruce, I think the most important thing that we were talking about yesterday even is that if the dollar devalues, it's going to devalue across all asset classes. And so you're still going to proportionally have the same amount of purchasing power if you do have your money in life insurance.
Yeah, that's very true. But once again, when we make that statement, we're comparing it to whether I should have it here or in another asset. And that's because you're trying to look at the rate of return of the insurance company. And as Nelson has said 150,000 times when he was alive, it's not about the rate of return. It's about the banking function and the control. So I'm not saying you should not worry about the devaluation of the dollar. But what I'm saying is this is not about rates of return inside your insurance whole life insurance policy. It's about the banking function. Whether the dollar devalues or not, the banking process goes on. So I think what people are worried about is they say, well, can the insurance companies stay up with what their guarantees are? So it just stays viable. They're not even worried about the dividend, but they're saying, can they stay up with the guarantees? And Chad H just asked a question: will insurance companies do anything to mitigate the after inflation impact of substantial currency devaluation, such as shifting a portion of their investments away from fixed income towards hard assets? So just to be the insurance companies do shift portion of their assets currently, or they do have a portion of their assets in real estate and mortgage-backed real estates. So those are hard assets. You could say that bonds maybe are not hard asset. Maybe that's your opinion, but the type of bonds they also purchase are corporate bonds that are backed by hard assets, whether it's the buildings, whether it's train box cars, whether it's computers, whether it's industrial equipment, it's backed by some hard assets. Now, treasuries are not backed by hard assets. And I think this is where people are worried. It's like, well, it's only about the faith of the US dollar. But it's about the taxing authority of the US government to make good on those bonds. But that's where people get worried because they say, well, this is the Keynesian idea of economics is, oh, well, we're never going to default on our obligations because we'll just print more money. And the Keynesians do not believe that's a problem. But the everyday Americans logically say, well, that's a stupid thing to say because that's going to devalue the currency. But the Keynesians say, but you have more money in the system. The more money in the system is going to spur more growth. And so you're going to have higher GDP. So the ratio of GDP to the debt stays relatively the same. The problem is there's boom and bust cycles along the way that there's going to be that if it was linear in the progression, then that would be okay. But there's the human element that causes boom and bust cycles. And the boom and bust cycles then cause short-term growth and short-term pain. And so that's what people are worried about is the short-term pain. So Chad asked another question. Corporate bonds may be backed by companies and hard assets, but corporate by nature are fixed income. So you don't get the benefit from inflation, you lose. I have to think through that, what you're saying. Once again, I do believe that there's going to be, just like the Austrians believe in the boom and bust, some corporations are actually going to benefit from hyperinflation because people are going to be pushed into that direction rather than another direction. So I'm not sure you could say that is true across the board. That's just a matter of an opinion. Austrian economists would say that if left alone, the people will make the correct decisions and eventually you will get the correct outcome. But let's get back a little bit to why I don't believe we have to worry totally about the US dollar being replaced. Because I think I don't have a crystal ball. All I can do is have logic. And I was inspired about 8 years ago when I went to a conference where somebody actually talked about the United States. It wasn't just about its ability to have freedom in the economy for growth. It was also about our geographical position in the world. So just the positioning of the United States, actually, we have a lot more advantages for economic growth because we are protected on both sides by vast oceans. So if somebody tries to attack us, it's very difficult for them. We have relatively stable and good relationships with Canada and Mexico. And so we're not threatened by them overtaking us. We have a waterway system that goes from west to east to the Missouri and the Mississippi River down to the Gulf of Mexico. We have a waterway system that goes from the east to the west in the form of the Ohio River that also moves goods and services. We have railway systems that work across the United States that moves goods and services. We have an interstate system that moves goods and services from the interior to the coast and the coast to the interior very easily. So the combination of all the position of the United States, the geopolitical certainty of Canada and Mexico, the geopolitical certainty of the protection of these vast oceans, and the way that we have a systematic way to move goods and services across the United States puts us into a position into the world's economy that is very, very good. Then you take the fact that who's going to replace the dollar as the world currency? So a lot of people are pointing towards some of the countries like North Korea, Russia, China, I believe Venezuela, where they're starting to put a group together where they're starting to trade in the yuan, the Chinese currency. Well, that's fine. Well, I shouldn't say it's fine, but I mean they can do it within their little, but their economies are really unstable right now also. But the most important thing is they're not trusted company or countries from the other countries. So oh, I guess Iran's probably another one in there. So are you really going to trust that the world is going to trade in the yuan when China has so much that other countries are wondering what they're doing, not only manipulating their money supply. Now we manipulate our money supply, but not to overtake the world in viewpoints. It's actually to try to smooth out boom and bust cycles. Maybe some people could argue that's not the only reason. But then you have the people say, well, that what about the euro? Well, the euro is still relatively young, and some of the major countries like Germany and France, who are supporting economically some of these other countries that are not in very good shape, there's turmoil in the European uh, way of doing things with the euro, so much as we know that Britain, with Brexit, actually got out of that situation and went back to their currency. So I don't believe the euro is going to be also a viable world um, trade on with the euro in the world market. So all those factors, I'm not saying there's not going to be hyperinflation. I just believe we are the best person, the best country amongst a lot of bad choices. So that's all we have to worry about.
Bruce, I love just hearing you talk about the strength of the US in terms of trade and our positioning. That's fascinating. It's also fascinating to hear why you think, and just based on historical and logical and factual evidence, that certain other currencies are less likely to be used as the reserve currency of the world. I think so I see two major questions really coming up out of this. And one is, if we still need to do banking, I mean, you're talking about banking as a process, it's a function that we need in our life. Where's the best place to do that? So that's one question, which we can unpack that a little bit more. And then the other side of things is, okay, but if I'm still a little bit concerned about the dollar, how do I position myself to have other assets as well? And what do I do with those in relation to life insurance? Like, can I buy life insurance with crypto? Can I buy it with gold? Can I convert it into gold or crypto? And or other hard assets. And so let's kind of unpack those two things. But on the banking side first, you keep mentioning there's a continual need for banking. We all have a need for banking. And when we think about banking, what we simply mean is you have a need to store money somewhere so that you can use it. And so when you have money flow into your life, it's got to be placed somewhere so that you can access and use it. And when we put it into the American, maybe American is not the right word here, but the typical banking industry, and we store it with a bank, then they have control over that capital. And usually, if we want anything in excess of that capital, we're asking for a loan to be able to borrow against something or against nothing. If it's unsecured line of credit or loan, we're in a position where we're having to access their capital, leaving the bank in a position of being able to use what's that? Arbitrage where they're taking in at a low rate and sending out capital at a higher rate. So they're earning the difference. They're earning cash flow. They're in a position of being able to make the decisions because they have capital. And we're saying if you reclaim that banking function and take it over personally or privatize it, you're in a position where you are then storing your own capital so that you can borrow against that capital. You can use your own capital in a way that does not inflate the currency supply and does not put you in a position where you have to depend on the banks to access capital. You don't have to pay interest to them. You're in a position where you are controlling the cash while you're storing it. So during the storing process. Bruce, is there anything else you want to mention about the banking function, the banking need that we have, and why infinite banking is the best place to do banking still?
Oh, I really think that what happens here, and I understand people's emotional response to this, because this is the Austrian way of thinking, is that individuals will take care of themselves first. And it's the idea that individuals taking care of themselves first will then do what's best for society. And I know that's in contrary to what really a lot of people believe. They say, no, individuals are selfish, so they're going to take advantage of other people. They might in the short term, because anything can happen in the short term. That's the boom and bust cycle. And frankly, but in the long term, they're going to figure out that if I treat somebody poorly, yes, I'm going to take advantage of it for a short term, but on the long term, it's not going to be good. So there's going to figure out like, okay, I'm going to push the envelope a little bit because I got to take care of myself and my family. But if I push the envelope too much, I'm going to be isolated. And that's not what's going to be good for myself and my family. So I think what happens here is I don't blame people for doing this, but what happens here is people look at this as like, oh, should I be doing this capitalization in my policy? And actually, this is what, and I just lost it. Yes, another real good question, and now I can't find
I
my
can read the comment here from Chad.
live chat. Chat. Oh yeah,
Okay, so
you're
he said,
100%
go
right.
ahead.
You're 100% right, and you'll always have a banking function. But how should people think about capitalizing right before a potential huge period of currency devaluation rather than buying hard assets? Well, this is what this is the mindset that I don't blame you for having. However, I want to try to rethink your thinking. That was Nelson's fifth tenet of infinite banking. We're still stuck in this short term thinking. The banking function is going to go on, for history. It might not go on through a bank, it might not go on through an insurance company, but it's going to go on. There's going to be banking needs between individuals, corporations, so on and so forth. But what we're thinking is, oh, we're going to go through this devaluation. Should I be capitalizing? My question is, where else are you putting the money? You're going to, for banking purposes, you might say, well, I want to put it in gold, or I want to put it in real estate. I want to put it into a commodity. Fine, do it, but capitalize first, just like you would put it in your bank first before you paid for these other things. Put it into your policy. You're going to get the guarantees. You're going to get the protection. You're going to get an uninterrupted compounding. You're going to then you would have to pay the loan back at the bank if you were going to go buy a hard asset such as even a business. So just use your policy like you always would use. Yeah, maybe they don't pay as high a dividends. Yes, maybe there's higher interest rates of the loans, but you control it. You're not relying on the banking situation. So that's how I would respond to that. Great question, Chad. And then Fritz, of course,
Wait,
Fritz always has great.
Bruce, on
Go
what
ahead.
you just said, I want to be really clear what Bruce is saying and what he's not saying. He's saying you've got to put your money somewhere in order to make transactions. And instead of putting it in the bank, put it in a place that you control. So that's where infinite banking is different than storing your money in the bank. We're comparing putting money into savings and checking and using the bank for that process of transactions, or using whole life insurance for that. So that's what we're comparing. What we're not comparing is whole life insurance versus hard assets, because the challenge is we're not looking for the best rate of return. We're not looking for what's going to just get a higher rate of return in that collapse or devaluation situation should that occur. What we're saying is you can do both, because life insurance is an and asset. You can put your money into the best banking system, which the best banking system is infinite banking, if you're going to privatize the banking system or banking process in your life, and then use that to borrow against to put money in other hard assets, whether that be gold, whether that be real estate, whether that be land, whether that be commercial real estate or buying businesses. So you can do both. So you're banking first in the best banking way, the best banking process, and then buying other assets with that banking.
Yeah. And Fritz and Chad both ask about whether insurance companies are considering putting money into gold. I've been doing this since the 80s. I would say I've talked to three different CIOs, chief investment officers of mutual companies in, I would say, relatively recent history, last 3 years. And all of them reiterate the fact that gold is still a speculative investment. So the reason people like gold or any other precious metal is because the value in their mind can never go to zero. Okay. But the value can actually decrease beyond certainty a lot. And I'm going to give you an example. When I was growing up, my grandfather, during the Carter administration, where we had extreme inflation, bought silver and encouraged me to buy some silver, and he would give me silver coins. It was at $50 an ounce. Less than a decade later, it was at $5 an ounce. So people think that precious metals will hold their value. And they say, but traditionally it's gone up in a deflationary environment. But that's because you're looking at it at your time period. I want to try to protect my time period, but it's still speculative during your time period. Insurance companies are looking for certainty over hundreds of years. And so they are not going to put their money in what they believe is speculative um, products. And so that's why they tend not to put money into gold and silver, because it's still a speculative product. Now you could argue, and I know what everybody's thinking now when we say that, yes, but there's no guarantee of these bonds and so on and so forth. Well, that is true, but the bonds in their mind are backed by something and there's certainty. It says if you hold it to maturity, you're going to get this rate of return. Most people say bonds are a bad situation because they're going to devalue. They do devalue, but you do not lose the money. It does devalue. I'm not arguing that, but you return, the money is returned at maturity. We tend to think about maturity being short term. Insurance companies are looking at maturity as long as possible because they can hold the bonds to maturity. They don't have to sell them at a discount. Why? Because they have new premium coming in every month to buy now the new inflated bonds. Because if interest rates go up because of the devaluation, or interest rates go up and then you devaluate the currency, that means the bonds that they're purchasing are also going up. Now, I know what people are screaming at the podcast right now and say, yeah, but we can't buy as much. That's because you're looking at the cash value as being a devalued situation, which it is, but the other assets that you're putting it in are also devalued. But if you believe that they won't devalue during that period, well, then take your cash value and go buy those. It's the banking function.
Meaning
It
borrow
is
against your
not a rate
policy.
of return. Borrow
Mm-hmm.
against your policy. Yes.
Yes. So what's really, really interesting about this is that I think the most important thing to take away is that any asset that can drop in, we're talking about dollars because that's what they're valued in. So if it can drop in dollar value, then it's volatile. You have the potential where when you need to get out of that asset or when you want to sell it, the dollar value has decreased. When you look at something like putting your money into cash value life insurance, your cash value is a guaranteed dollar amount. So while the dollar itself might have less worth, you're not dropping in you're not dropping in dollars. Period. I'll just say
Correct.
dollars.
Correct.
So
Correct.
because of that guarantee, you have a lot more certainty to make better decisions. And so there's a difference between something that can go from $50 an ounce to $5 an ounce. We saw a very similar situation, and I'm not knocking gold and silver, but our timing and our expectation did not match up. So we were thinking, yes, it is a hard physical asset. It will hold a long-term store of value, and over a long term, it does. But there is volatility along that curve, meaning that when we bought gold and silver, I don't remember the exact dollar amount, but we were buying in an environment where it was increasing in price. And then we went to sell, and we had to sell at about half of what we'd purchased at in order to be able to liquidate and use the cash. And so it wasn't a good banking tool. And if you need banking, you need something that has a guarantee of a dollar amount, not a volatility of something that can drop in dollar assets or dollar amount. Um, Bruce, I think another piece of this question that we need to tack on before we close this episode, and thank you all for being here and asking great questions today. Continue to ask your questions. If we don't get to them in this particular episode, we will address them in a future episode. But another question is, can I use gold or crypto to buy life insurance at this time? And so there's a short answer to that, Bruce. Go ahead.
Yeah, no. But what, I understand why people are asking this again, but I mean, all you're going to do is under the current system is change crypto into USD and then buy it, or change gold in the USD and then buy it, the premium. Okay. Then you can take premium because, as Fritz just said so elegantly, as Fritz always does, cash value is a creature of exponential growth because of the uninterrupted compounding. So now you then borrow against, if you're so hung up on hyperinflation, borrow against, I put it back into my gold, I put it back into my crypto, and now it goes up in price, which everybody believes it will be. And then you use the appreciation to pay off the loan, and you just rinse and repeat, rinse and repeat. It takes discipline. Any of this short-term thing takes discipline to carry through. If you just remember that if I place my dollars, whether they're USD that are just regular USD, or you purchase them with crypto, or where you purchase them with gold, they're USD. Until we start trading in gold again, or until crypto has utility, there's not going to be anything but USD dollars in the United States. They might be devalued, but that's still what you're going to use unless you move to another country to purchase other assets. And I'm not trying to belittle people that are asking this question, but I want you to rethink your thinking. I want you to think about all you're doing is the banking process. It doesn't make any difference if it's in gold, in crypto, in seashells, in barley corn, in anything that has been used in the past for trade. It's going to devalue, but that's okay. So are the other assets that you're trying to figure out which asset. That's the wrong question. The wrong question is, where do I do the banking process? And that is the first place I put my money. Then I go do the other things to help with the devaluation of the dollar.
And if you're going to diversify your assets by borrowing against your policy and putting it into other things, you can put it into foreign currencies, precious metals, cryptocurrencies, real estate, barterable goods, durable tools and equipment, seeds, food storage. I mean, you can put it in anything. Just make sure that you have a good banking system first. So,
I hope I get
Fritz, go
I know
ahead.
we're going to wrap up. I hope I get to meet. I hope I get to meet Fritz in person sometime. He says insurance policy is not a banana taped to a wall that can be bought with crypto at an art display. Fritz, I love how you bring things down to a commoner's way of looking how the ridiculousness of this is sometimes. I just want to encourage people to stay positive. This is not the first time that there's been turmoil in an economic situation for countries. It's not the first time. Okay. And I appreciate that people are looking for the answers in advance. That's what you should do. But I just want to encourage you and say that you are still in the best economy on the history of the planet. You could argue whether it's going to remain like that because well-respected people like Ray Dalio has written a book about how the rise and fall of these other uh, civilizations, but it wasn't this, in my opinion. And I'm not saying I'm as smart as Ray Dalio, but I do know Ray's selling a book on this topic, so you got to take that with a little grain of salt. Um, that we have changed because of crypto now, because of the advent of the internet, because of the way we can communicate across the world, because of the interconnectedness of the world. I do believe it will smooth out if you understand how the short-term pain will not happen forever. You cannot have hyperinflation forever because I don't care how big the wheelbarrow is, eventually it won't be big enough and people will not be able to buy things. So prices have to come down. And that's also been proven over and over and over in the history of civilizations.
So here's the point. All of this comes down to your thinking should be abundance thinking, not scarcity thinking. And if you're making
Exactly.
decisions in fear, you will not be making good decisions. So take the whole picture, take all of the information that you can, but continue to make decisions in faith and confidence to do the best thing in the widest range of circumstances that can not only benefit and better you, but also generations to come. So we're going to go ahead and wrap this episode here. And
Hey, Rachel, I'm sorry. I know we're extending this, but this is a very important. And if a person's going to listen, I want to take care of them. Esther asks, I have an important question. God forbid that the beneficiary passes away before the person who has the policy does. What takes place now on that policy? Esther, it depends on your state and how they pass along um, actual assets to the next generation. Every state is different, but most of the states have a format of distribution if there's no beneficiary. It has to go through probate, but it'll eventually get whoever is like in the state of Missouri. Um, if the beneficiary has a spouse, it's a spouse. If they don't have a spouse, then it goes to the parents. If the parents aren't alive, then it goes to, and I'm presuming they don't have any children, because after the spouse, it goes to children. If they don't have any children, it goes to parents who are alive. If they don't have any parents, then it goes to siblings. If it doesn't go to siblings, then it goes to their next of kin, like a first cousin. So there's a structure in place. So I wouldn't worry too much about that, but I can't really answer that for sure because it depends on your state. Then she said 3 years ago, I opened a whole life
this
for
is
each of
someone
my
else, Bruce.
girls.
This is
Oh,
this
I'm
is a new
sorry.
person, Evelyn.
Oh yeah, it's another E. Best Christmas thing I ever gave them. I agree. That's Evelyn. I don't know if you heard my story. My father took out a policy on me in 1963 when I was born, handed it to me on my wedding, and said you could borrow against this policy to put a down payment on your first home. It was such a great gift. So thank you for all these great questions today. Thank you for our esteemed listeners, and we really value you listening and we really value these questions. Great questions and comments today.
Absolutely. So don't be surprised if those questions turn out to be future episodes as well as we unpack more of these things that are top of mind to you, our amazing listeners. So thank you for being with us on the show today. And please remember in closing, well, let me say before closing, I'm off my typical process here. If you want help with life insurance or just looking at your finances in a way to optimize everything, your cash flow, your net worth, being in a position of making the best financial choices with your current financial landscape, your financial picture, we can do that for you. Go over to themoneyadvantage.com and book on our calendar to get an appointment to really talk about how to implement these things in your personal life. So, in closing now, remember success leaves clues. So, model the successful few, not the crowd, and build a life and business you love. And if you're listening live, happy Thanksgiving.